well, we see Orkestra as a key enabler to achieve our net zero goals globally. And one of the things that really stuck with me was the statistic that I read in a Bloomberg New Energy Finance report back in 2021, where they looked at what was the increase that we needed to do in terms of deployment of new energy technology globally to achieve our climate goals of keeping our temperature of the globe below 1.5 degrees. And they determined that we needed to be deploying 5 times as much wind, 3 times as much solar, and 26 times as many batteries every single year compared to 2020, all the way to 2030. Now, obviously, we're not going to have that step change, so it has to be some kind of exponential growth. But I looked at that and I went, we are not going to be able to train enough people in 10 years to solve this problem. We have to achieve that goal through automation and productivity improvements. And so Orkestra very much goes straight to the heart of that.
Welcome to this episode of Abstraction, a podcast that with the help of Australia and New Zealand's leading entrepreneurs, investors and experts, breaks down the complexity of emerging tech trends. My name is Hunter Watkin. I'm a tech startup investor at Rampersand, an early stage venture capital firm, and I'm on a mission to learn out in the open with those curious to understand what's currently possible when it comes to emerging technologies and bring to light how people and companies are overcoming the obstacles that lie ahead. This season is all about carbon-related technology. I'll speak to guests using tech, engineering and science to drive carbon removal and reduction projects, as well as the investors and leaders mobilising change in what many of my guests are calling the decisive decade. You can catch every episode by subscribing on Spotify, YouTube and Apple Podcasts, or following me, Hunter Watkin, on LinkedIn and Twitter, so you don't miss a beat. Before diving into this episode, please be aware that nothing expressed throughout constitutes financial or investment advice. We hope you enjoy. Today I'm joined by James Allston. He's the CEO and co-founder of Orkestra. Orkestra is a software company that helps customers understand the costs and returns on investment of solar, battery and e-mobility projects. Before diving into the details, James, would love to hear a little bit about, the sequence of steps that led you to team up with your co-founders, Chris and Michael, to start Orkestra.
Yeah, actually, I should point out that I'm co-CEO. So I co-CEO with Chris Cooper, who's one of my co-founders, first off. But yeah, thanks very much, Hunter. Yeah, so I'm actually a Tasmanian. I grew up here, went to school here, went to university here, got an engineering degree alongside a science degree, majors in physics and mechatronics. So actually really quite technical start of my career, but then ditched engineering pretty much straight away. So I joined Siemens, a big German technology company that most people would know, and worked with them in product management and marketing roles, like strategic marketing roles, for nearly 6 years, both in Australia and then in Germany. And that was really focused on energy efficiency and energy management. That was the sort of start of my career. And at the time, when I started my career, solar was $10 a watt, right? So today we look at solar and we're like, man, it's so cheap. You'd just be absolute no-brainer to do it. You're buying it at $1.50 a watt. But at the time it was $10 a watt were the kind of quotes that we're getting. So a lot of the early, clean tech space was very much focused on energy efficiency and energy management. So that's sort of where I cut my teeth in that area. And then after finishing up with Siemens, I worked for a year with a mid-stage startup called OVO Energy. It was mid-stage at the time. It's now bought one of the big six in the UK, which is a little bit equivalent to buying, Energy Australia here in Australia. So it was a pretty bold move for them, but they were a fantastic company. And that was when I sort of got my first taste of working with fast-moving startup businesses. So I think that sort of headed me off in the direction of probably doing my own startup at some point. And my wife was also doing the startup at the time as well, in the UK, which sort of I could live vicariously through her startup experience as well. And then back to Australia, I worked with Gemini, who's a big electricity distributor and gas distributor, and I led a strategy team running their emerging opportunities task force, which was looking at all the new energy opportunities in Australia at the time. This is about 8 years ago. And that was when I really got an opportunity to see all the exciting stuff that was going on in the new energy space and started to look more at solar and batteries and stuff that's happening front of the meter. So all the big battery projects were starting to come to the fore at that stage. And after working with Gemini for a year, I realized that lots of businesses needed strategic support in new energy. And I was firmly of the view this was during the Tony Abbott years, that the only way we were going to make progress on climate was by teaching businesses and rich people how to make money on the solutions for climate change. And so I started a management consultancy called New Energy Ventures, and I worked in that business for nearly 6 years, helping a very large range of businesses, from property developers to energy companies, understand how to make money out of the new energy solutions. And it was during that time that I met my co-founders, Chris and Michael, who were employees of mine at New Energy Ventures. And we were developing up lots of IP around feasibility modelling of solar and battery projects and e-mobility. And when COVID hit in 2020, we had all of our forward revenue dry up literally overnight. Like as a management consultancy, doing strategy projects that were kind of a bit of a luxury, like all of our customers just hit stop on everything. And we're very fortunate to have money in the bank, and very fortunate to have Scott Morrison throwing cash at us, small business. And we were able to plow all that money into looking at the commercial industrial solar and battery opportunity in Australia. And we wrote a white paper on that. And to write that white paper, we developed up the code base that still forms the core of Orkestra today.
It's quite interesting that in the midst of COVID, you moved from a service-based company to going kind of all in on writing a white paper, building a code base, and pivoting to a tech company, which entails a much higher level of risk. What was the catalyst? Was it like, we've got no customers, we've got a bit of money, let's run hard at turning this into
we didn't quite get all the way to a software business at that stage, but we had a lot of customers that we'd been speaking to about commercial industrial batteries and virtual power plants. And we saw a massive amount of interest in that sector. And we thought, like, no one has written anything in Australia on this topic. No one has explored it in detail. And we saw this as a potential short-term way of getting some cash in the bank. So it took about 2 months to write the white paper. We sold about 50 copies in the end, I think, $2.5 to $4,000 a pop. So it was like, it wasn't, a massive money spinner, but it was something, it was kind of like, what do we do now with all this knowledge in a moment of desperation? So,
what a great way to bootstrap a startup.
Exactly. Well, and then so out of that, we had this Python code, and we started consulting with this Python code and running a modeling service for batteries. And with we had a bunch of really interesting projects that we did with some customers in that space. But again, universal feedback at that point was, you're too expensive. We want to do this ourselves. We don't want to have to pay you guys to do this modeling service. We want you to turn this into software. So we took that feedback and we started talking to customers around what that software would have to do. And we looked at the incumbent, businesses that were available at the time. And the clear feedback from our customers was, there is no current solution in the market that you can put a person, like a salesperson or a junior analyst in, to that software, and for them to comfortably use the software to generate viable projects. And the solution was either Excel, which, we had categorically proven you couldn't do, sophisticated battery projects with, or buying a piece of software like Homer, which is a legacy piece of software, really wasn't optimized for the Australian environment. We had a competitor that was coming out about the same time, and they didn't read the opportunity properly, and they built something that was like Homer, but much more powerful, but you needed a $200,000 analyst with 10 years of experience to run the software. And so we came to the view of, we need software which is fast, easy to use, and produces accurate outcomes every time. And that became a mantra for our business around what are we going to build as an organization and this piece of software. And that is bearing out. That strategy now is proven to be the correct one. And we're just, we're eating off the market. I don't know what our market share is just yet, but like, we pretty much got all the tier 1, tier 2 solar and energy, solar installers and energy businesses in Australia now using our software.
Talk to me about, so one thing that I've observed about some of the best emerging software companies, particularly in the climate space, in the energy space, is they do have this sort of origin story around being a consultancy or providing value that way, and then evolving into, I guess, a more efficient venture capital appetizing business. Tell me about the trade-off between education in the early days and just trying to be a self-serve kind of product-led growth business. Like, is this a constant battle?
Oh, 100%.
What's that relationship?
I mean, it's the biggest challenge. I mean, both for us as culturally, as an organization, that that built a whole business around educating its customers, right? That's a huge cultural shift as a business to sort of go, actually, we need to stop doing this. But also the other side, which is the tension of, we're trying to produce software that's easy to use, but there's a lot of prior knowledge that you need to bring to this software. And there's just stuff that you just have to come up the curve on to be able to do. So take a big portion of our customers are solar installers and come from, installing a technology that is frankly relatively straightforward from a sort of complexity of both the delivery of the project, but also the feasibility modeling side of it is relatively straightforward. And then as soon as you add a battery to that, the complexity goes up enormously, right? Even with a battery that has a relatively simple control system and what we call a value stack, which is the different revenue sources that battery is going to be able to tap into. And then when you want to do stuff that is front of meter, i.e. participate in energy markets, which is, what you would see, people obviously would have heard of things like the Hornsdale big battery that Tesla built, a few years ago. That battery is participating in energy markets, but behind the meter batteries in the commercial industrial world can participate in those markets as well. And when you add those into the picture, your complexity just goes skyrocketing through the roof. And so that tension now of we want to try and give this software so that we want to make this fast, easy, and accurate so that all those companies can use this software and, comfortably get accurate results. But there is that kind of tension with you do need some prior knowledge of how these things work. So customer success has been a massive thing for us, right? Not just on how to use the software, but also how to use the software in the context of what you're trying to get the project to do.
Absolutely. We'll get into the weeds of sort of behind the meter, in front of the meter batteries, where Orkestra plays, and a bit more about the problem. But before we do, you note that as a founder, something that, in the midst of COVID, maybe you weren't necessarily planning this, I'll hear your answer, but you moved from a service-based, being a code base, and pivoting to a tech company, which entails a much higher level of risk. What was the catalyst? Was it we've got no customers, we've got a bit of money, let's run hard at turning this into a bidding with regard to solving our broader kind of emissions problem?
That's a really good question. So as a business, another big part of our mission, which sort of kind of goes right back to the beginning of what, New Energy Ventures was doing around teaching businesses how to make money out of the solutions for climate change. Well, we see Orkestra as a key enabler to achieve our net zero goals globally. And one of the things that really stuck with me was the statistic that I read in a Bloomberg New Energy Finance report back in 2021, where they looked at what was the increase that we needed to do in terms of deployment of new energy technology globally to achieve our climate goals of keeping our temperature of the globe below 1.5 degrees. And they determined that we needed to be deploying 5 times as much wind, 3 times as much solar, and 26 times as many batteries every single year compared to 2020, all the way to 2030. Now, obviously, we're not going to have that step change, so it has to be some kind of exponential growth. But I looked at that and I went, we are not going to be able to train enough people in 10 years to do that, to solve this problem. We have to achieve that goal through automation and productivity, improvements. And so Orkestra very much goes straight to the heart of that. So historically, you could have set up a site and run it in Excel, and you might have had an analyst sit there for 3 days, kind of crunching out the numbers, trying to optimize the solution and get to the right result. We can't do that anymore. We don't have the luxury of time to be able to do that. So our software, you can set up a project and you can run 250 different solutions in about 10 minutes from start to the end. And then you might do a few refinements, but within an hour, you've solved your problem. You've worked out exactly what you're going to sell your customer. You've worked out the net present value, the IRR. You've optimized the solution. You've optimized your value stack. You've thought about your sizing of the technologies, all within an hour. And that was just not possible before we came along at all. And so tying that back to that point around our need to scale, we're trying to both increase the productivity of those analysts and make them better at their job and faster at their job. But also the fast, easy, and accurate is about also giving other people in their organization that might be sitting alongside those analysts, so salespeople, product managers, the superpowers, because it is superpower, the superpowers to go and do the same work of the analyst. So the analyst might be able to hold their hand on the first 10 projects, But after that time, they should be able to be off and running and be productive themselves. And it's through that, then we're going to get to those kinds of like exponential growth, because now we can take people that previously couldn't do this work and now they can, and we can sell faster, sell easier, get more projects happening, deploy more capital quicker, without having to massively scale our human resources.
Higher NRR, you get sort of the champion within an organization. It spreads. It's a venture capitalist wet dream. When you sort of mention selling to your customer and then them selling to their customer, I think it'd be helpful for the audience to kind of visualize or understand a use case around who Orkestra's customer is in this commercial and industrial segment, and then who their end customer is, like who's going to be the beneficiary of the project that Orkestra is aiding.
Yeah, so we have sort of three main camps of customer. So camp A is a solar installer, or what we call an energy service company, or ESCO. And that might be an Origin or an AGL. So some business that has probably come from an energy retail background, but is starting to move into installing new energy technology as part of their business, right? And pretty much all of them, all the retailers now are thinking about that in some form. So that's our sort of first camp. And for those guys, we're enabling their sales teams, right? And we're enabling them to sell these assets and do it faster and easier. The second camp is finance companies for these technologies. So we have a few companies like Green Peak Energy and others like them that are looking to finance the asset. So they're not the installer, they're not going to be the boots on the ground, but they're bringing the cash to the table, and they're looking at our technology as a way of streamlining their processes and getting much faster. And then the third and final camp is kind of like a catch-all of people like energy consultants who are doing owner's engineering and supporting, maybe businesses to kind of buy these products and services, or sustainability teams within large portfolio companies. That sort of catch-all of like the final, camp. And then the end customer for us, so who ultimately gets the outputs of the software, will be commercial industrial businesses. So as an organization, we saw that the biggest opportunity in terms of kind of untapped opportunity that was out there in this space was in the commercial industrial space. So if you look globally at electricity consumption, 2/3 of electricity consumption is in commercial industrial. And obviously the rest is resi and a growing portion of e-mobility, but commercial industrial is very much a space that needs attention. And no one was really serving that space effectively. We've aimed at that as our sort of like home ground. But it's very much anyone who wants to understand the commercial outcomes of these technologies will get benefits out of our software.
And when you talk about seeing the biggest opportunity in this commercial context, it kind of refers to that behind the meter versus in front of the meter setting, and why the behind the meter is an area where there's great opportunity. You've been relied on recently to write a paper for the government. I don't know if it's the same white paper or a different one among many, where you basically had really strong views about the differences between in front of the meter, between the meter, or I guess neighbourhood batteries, and behind the meter batteries. And basically your view was that the neighbourhood battery concept that a lot of government and policymakers have been ploughing money into, the jury's still out on whether that's going to be economically efficient and just work from an incentives perspective for the stakeholders involved. Would love to hear kind of a breakdown on what the in front of the meter, behind the meter neighbourhood batteries entail, and why you reach that perspective at a high level.
Yeah. So let's just start off with front of the meter batteries, because I think like there's so much press about that. So I think that's quite a common use case that I think the listeners will probably be used to. So that's your Victoria big battery and your Tesla big battery that's in South Australia, those types of assets, right? Huge, big, paddock of shipping containers full of lithium. And they are participating directly in electricity markets, and two different types of markets. So one is the wholesale electricity market, and the value is created by buying energy when it's cheap and selling energy when it's expensive. And in Australia, what we're seeing is increasingly in the middle of the day, due to large amounts of solar being installed, prices are going very low or negative. And so a battery can buy power when it actually gets paid to charge, which is, as opposed to having to pay to charge, which is what everyone would be used to, right? As a homeowner, you're just used, when you draw energy from the grid, you pay money to the grid, to someone. Whereas in these situations, they're actually getting paid to charge because there's too much energy available in the system. And then they're going to able to discharge during the end of the day when the solar, obviously the sun has gone down, there's no solar generating in the system. So now you're reliant upon coal and gas and wind to basically supply the system at that particular time. And it is now getting very, very expensive to supply energy during that time. Average prices that we're looking at across many states is, in the range of sort of $250 to $400 a megawatt hour. So bringing that back to sort of a homeowner's bill, that's sort of 25 cents to 40 cents just for the electrons, not including all the other stuff that you have to pay for, like the network and all the regulatory fees and market fees and things like that. So very, very expensive. And so that difference between, say, $50 a megawatt hour and $400 a megawatt hour is exactly what these batteries are going after. They're trying to capture that arbitrage in the market. And then there's some other markets which are kind of a little bit more technical, which are around frequency control, which probably don't need to go into too much detail about, but that is also really valuable for those big batteries. And that's the value stack, right? So those two things make up the value stack. You make an investment and those batteries participate in those markets and make their return. And then you're on the other end of the spectrum, you've got behind the meter batteries, which is, if you're a homeowner and you've installed one of these, you literally plug it into your system and it will store energy in the middle of the day when you're generating off the solar, and you'll use it later in the day. And that's a very sort of simple use case. And commercial industrial batteries are similar, slightly different use case. They tend to be more around managing the demand of a site. So the peak of when electricity is consumed by that site on a month or a year. They might do time of use arbitrage. I was working on some projects for the customer this morning, very similar to that use case of their residential. And they may also participate in the front of meter markets like the utility scale batteries. So those are kind of like the sort of two ends of the spectrum. Now, let's get to neighbourhood batteries. So neighbourhood batteries fall down on a few fronts. They are trying to do the task of a behind the meter battery while sitting in front of the meter. They also trying to compete with the utility scale batteries while being twice as expensive to deploy. So on a cost per kilowatt hour basis, so if you bring this back to like a per unit basis, they're about twice, probably up to twice as expensive, typically around twice as expensive to deploy. And so you've got a return which is on the same revenue stack, but twice the cost. Your IRR is not particularly attractive.
And James, that's largely because, to oversimplify, I guess, energy markets, you've kind of got nodes which are kind of in front of and behind the meter batteries, and then you've got these railway tracks in between. And what neighborhood batteries are really doing is just not being a new node. They're kind of just trying to sit on the track.
I think that's a reasonable way of describing it. When you're behind the meter, the what you can kind of offset in terms of the energy costs. So if we just think about, like, you might have some listeners that are on like a time of use bill. So they might be paying 15 cents for off peak and say 35 cents for peak. And that delta of 20 cents is what you might be charging on the off peak and discharging on the peak. That delta of 20 cents is what's sort of helping to pay off the battery. Now within that, you've got a whole stack of different costs that make up that cost stack. So you've got the actual electrons, so the generation that comes from from the different power stations that are in the grid. You've got all the network costs, so the transmission, the big electricity wires that you see in the countryside when you go for a drive out in the country, all the distribution costs, which are all the poles and wires that you see in the streets, and then all these other charges as well that kind of lay it in, which are regulatory, but they're all hidden.
And it's not just a sort of distance basis. There's things like postage stamp fees.
Yeah, and that's the thing about distribution tariffs, right? They're postage stamp pricing. So whether your energy is crossing you have a power station across the street from you, or it's coming all the way from a power station out several hundred kilometers away, you pay the same price for that energy, right? And so this in lies like one of the issues is that, when you're buying your energy, you've got to pay for all those things. So people look at their bill and they go, like feed-in tariffs are a really good example of how people misinterpret their bill. Like I'm paying 30 cents a kilowatt hour for my energy, but I'm only getting paid 5 cents if I push it back in. It's like, well, yes, because that 5 cents represents the value of the electrons that you're producing, not all the other costs. So when you're that 30 cents, there'll be 5 cents in there for the electrons, and the rest of the bill is all your network charges and all your regulatory charges and all of the market fees all make up that cost stack. And that's the bit that's hidden from the average customer, right? And so when a battery is behind the meter, it can offset all those things. But if it's front of meter, then the only bit that you can tack is that 5 cents, right? So you start to see the difference between the front of the meter and behind the meter is really around what is the value of the energy that you're trying to offset and what makes up that cost stack when you're looking at these projects.
Slightly tangential question, but I have to ask. If I'm just a Joe Blow and I'm not setting up a behind the meter battery on my property, but I'm thinking about where I want to live, would it be prudent to understand where you kind of get the rough end of the stick?
Our software can be used for, Nana's flat all the way through to a utility scale power station. It just so happens that the people that really care about the economics of projects are commercial industrial businesses and financial decision makers. And our software starts to break down a little bit when you start to get to the very large scale of the battery. So we sort of say up to 5 megawatts, you're okay. And then there's above 5 megawatts, there's a bunch of sort of regulatory considerations and technical considerations that when you're modeling these projects, you probably be using another piece of software alongside our software to kind of do it. So you shouldn't just use our software alone, but it can, in theory, model these projects up to a very, very large scale, like the software's capable of doing it. What we find with the residential is that most people are buying solar and battery systems on an emotional bent, and they'll typically call someone up. They'll try and maximize the amount of solar they can get on the roof. They'll try and minimize the price as much as possible, and they'll try and make sure that aesthetically the solar system looks good. But from a financial return perspective, no one really interrogates that. And you can do it. You can go and sign up for a free trial in our software today, and you can probably find that within an hour, you can get in there and you can model a system and you can understand what it means. You'll find that batteries work in very few markets. Residential battery works in very few markets.
As in just the cost benefit is just not quite there unless you've got a really great surface area for solar on your roof or whatever it is.
The residential battery opportunity is where you've got, nice solar opportunity. So you've got a reasonable amount of solar that you can install on the roof. You have a fairly large amount of excess energy that's being generated, that's being pushed to the grid. And then you happen to be in an area where you have extreme time of use pricing. And the only place in Australia that has that is Ausgrid in New South Wales. And there's a few other kind of outlier cases as well where it might make sense, but that is, as if you're a solar installer and you're listening to this podcast, that's your market for if you want to sell on financial returns. It is in Ausgrid. So that's like the greater Sydney area in New South Wales.
And in terms of some of the macro things that are happening at the moment, maybe we can tie it back to how that might change in terms of demand for the domestic use case, or at least commercial. How have things like what's happening in Russia and Ukraine and the commercial relationships that govern the exporting of power from Australia and our access to it, how has what's happened over there impacted the short-term and potentially mid-term pricing of grid electricity?
Yeah, I think huge impact. It's starting to sort of come off a bit now. But if everyone recalls back a year ago, there was a lot of news about electricity prices. And the Australian Energy Market Operator, AEMO, actually shut down the market for about 10 days. And it was driven by the fact that, we're coming up to winter in Europe. Obviously, Russia had invaded Ukraine. Europe had decided to stop importing gas from Russia. It now needed to look at sourcing its gas to keep its homes heated and its businesses running throughout the winter in Europe. And gas prices went ballistic. That ended up having a flow-on effect to here in Australia, where for some crazy reason, when the Gillard government was approving the new LNG export facilities in Queensland, didn't put in a domestic gas reserve in the same way that Western Australia put in a domestic gas reserve there. Completely mad, completely foreseeable, was told multiple times that she should do it, and she didn't do it. And as a result, Australia's gas prices are pegged to international export markets, which means that we get no domestic benefit from having our own gas whatsoever. So what happens in the electricity market? Well, electricity prices go through the roof in that evening peak that I talked about towards the start of the program, where you are very reliant today on gas to generate electricity during those times. And the gas generators, the gas power generators, were basically not able to make enough money in the market because of the input gas costs. And so the prices just went ballistic. And if you look at like the volatility of 2022, it was compared to the previous volatility in earlier years, it was absolutely extreme. So in the 12 year, like in all years previous to 2022, electricity prices would exceed $300 a megawatt hour, somewhere in sort of the 0.5% to 1% of intervals. So that's the actual unit of time that the market is measured on. In 2022, it jumped to 15%. So the market went crazy. Now, of course, all that then has this flow-on effect to new energy, right? So if electricity prices are going through the roof, businesses and homeowners are going, shit, man, my electricity bill just went up 300%. What do I do? And many businesses are, if you're heavily dependent on energy to run a business, you need to start looking at options. And what we've seen, the sort of flow-on effect to the new energy markets is just a massive increase in interest and investment in new energy over the last 18 months, which I think will continue for at least another 18 months and probably longer. And as that new energy comes in, the market continues to change and evolve over time. So we're just going to end up with more of those price differences. So more solar means prices are more likely to go negative, and you're going to end up with peakier peaks in the evening. It creates greater incentives for batteries, and we're just going to see the whole thing has kind of got its own kind of momentum and motion now to kind of start deploying these assets.
So the general view is potentially in the short to mid term, this volatility of price is going to be the catalyst for adoption. It's not going to trend towards an equilibrium. We're going to see a sustained period over the next few years of volatility. And it's only once it gets to that level, I think the quoted percentage is 82% of renewable energy in Australia by 2030. It's only once it starts to tend to that this really starts to even out.
Oh, look, I wouldn't even call it that. I mean, a lot of the energy market specialists, which you should probably get on the program to have a dedicated session on this, just believe that it's going to get more and more volatile the more renewable energy we put into the system, that it's going to take a long while until we've developed up the battery storage in the market to kind of temper that volatility. And we're going to be hugely dependent on gas in particular for filling the gap, particularly in times where we have, periods of wind drought. And autumn is a classic case. Lots of people think, autumn, isn't it lovely and still? Well, lovely and still means no wind. No wind means we have to basically supply all the electricity that would have been supplied by those wind plants from somewhere else. So where are you going to get that? Well, you've got hydro. We've got limited options of that. Solar doesn't shine, outside the middle of the day. So we're going to have some kind of battery storage in there. And so we're going to need vast amounts of battery storage to be deployed, not just short stuff like 2-hour batteries that most homeowners are employing, but long battery storage like the snowy hydros, where you can store up energy during the winter when you might have lots of excess wind, or during the middle of the summer when you have too much excess solar, but then you're using it in those periods where there's a bit of a wind drought. And so all this kind of volatility, we're just starting to see, it kind of really start to ratchet up. And I think we can expect not a particularly smooth transition, as some people might be hoping, from our historical energy system, which was fossil fuel based and centralized, to a completely decentralized energy market that is supplied by renewables and other clean energy.
How do you think about, I guess, the catalyzing technologies for Orkestra, and what are the kind of barriers that you're impatiently waiting to be overcome to allow Orkestra to just really become a pervasive product that's used everywhere from a technology perspective today?
Actually, it's not technical. A lot of it's regulatory. We have the technologies, right? The technologies exist. There's certainly a lot of innovation that can be done in the optimization of batteries and the effective optimization of batteries. It's something that, as a business, we've thought a lot about because we're creating software that tries to mimic those. But from a technical perspective, actually, the technologies are kind of nailed, right? We've got very modular, highly scalable, manufacturing processes that can produce these technologies. And you can take the same technology that we install here in Hobart and install it in the middle of Africa and install it in the US or Europe. And it's the same kit, right? That technically, that hardware is actually kind of common. The complexity comes in, is introduced in the individual electricity markets around the world. And it's introduced in a few different areas. It's introduced in tariff complexity, particularly network tariff complexity. And here in Australia, we have some of the most ridiculous, most complex tariffs. We also introduced in terms of slight subtleties and differences in the way that markets are regulated. So in Australia, we have a completely deregulated market, meaning that we have separate parties that provide generation, transmission, distribution, and retail. But in other markets around the world, they may be vertically integrated, where you have all just one party. It all comes from one utility. You have other markets that might be semi-regulated. Even here in Australia, we have a wholesale electricity market where all energy must pass through. And so regardless of whether you're, a solar generator or wind or whatever it is, you must sell all your electricity into the market and then draw it out of the market. And then retailers buy hedging their products and insurance and kind of different types of financial instruments to manage their risk on trading through that market. Versus in Western Australia, we have a bilateral market. So in Western Australia, you'll have bilateral agreements that form between generators and retailers where they'll agree on a price. And then you have a balancing market that fills up the gap on those differences. That's just within Australia. And then even within the national electricity market, which makes up all of the eastern seaboard, all of the jurisdictions have their own kind of little tweaks on how that market should operate. So in Victoria, we have VEECs, the Victorian Energy Efficiency Scheme. In New South Wales, we have ESCIs, the Energy Savers Certificates. And so all of these kind of little subtle jurisdictional differences make scalability really bloody hard. Taking our software and deploying it in a new country, particularly for batteries, not less of an issue for solar, but particularly for batteries, because they have to tap into these different kind of opportunities, makes it quite challenging to move it around in market. So we've got ideas around how we're going to solve for that problem, but that is the core challenge for energy companies and people working in clean tech.
I mean, investors, people in venture capital, they're looking for infinite scalability from day dot, but with infinite scalability from day dot, you compromise defensibility as a business. So it's this interesting trade-off. It'll take you guys time, I'm sure, as you dominate Australia and go overseas to build up the momentum you have here, the quality of product and service you have here, but that becomes your defensibility.
100%, right? And there's the times where we're like, oh, can't we just do another calendar app or something that someone pays $5 a month to sign up to, and you can very quickly be in 198 markets or whatever the number of countries is now across the world. Yeah, well, that's good, but so it's not really solving the biggest issues, and it's not solving real, tangible problems for people. The thing that makes what we're doing exciting is that we're solving real challenges and barriers that exist in achieving net zero. And as a business, that's a very exciting problem to be working on.
And it's great that you have the software that can have that agitating impact, really catalyze a shift. I wanted to ask, this is a really pervasive topic in all of my conversations with startup founders, Scope 3 emissions and the measurement of it. In your business and what you see, do you observe multiple stakeholders within a supply chain? So call it the end customer and then your customer that supplies them. Do you ever observe these sort of co-investment relationships where they work together and the downstream buyer is relying on this upstream supplier and they're working together so that they can understand their emissions? Is that something you observe in your job?
Not really, no. We've seen different models out there that companies are, hoping to support. So Scope 3 covers, of course, all your employees' emissions and things like that. So there'll be EV fleet programs and potentially helping customers get solar on their roof and things like that. I think a lot of our customers kind of help work with companies to kind of make those kinds of programs effective. We are a business that is very focused on Scope 1 and 2 emissions, right? Trying to reduce direct emissions by helping businesses to electrify or, offsetting electricity emissions by installing solar and batteries.
It's a good place to be. The observation I have is if you're a company that's trying to help solve for the Scope 3 emissions look through, it's really hard to do that purely with software, just a software wedge. There needs to be the right incentives in place. It's a much slower burn. So I think it's a good place to be focusing on 1 and 2.
My recommendation on anyone who's looking at that Scope 3 problem is just try and find scalable options to address Scope 3. So don't try and hit the whole thing. Just try and hit a bit of it. So a piece of software that might help, say, a company help its employees to invest into solar. So it might pull together financing options and solar installers and the employees and the end customer, and you might look at that. And that might be quite a tiny little piece of software. You might find enough companies around the world to build a little nice business out of that, and you can take a clip on the ticket of what's, all the transactions that are going through it and stuff like that. I mean, that would be something that I would look at to try and focus on, try and find something that's already kind of scalable, and then put software around that, as opposed to trying to hit all of Scope 3 all at once.
Yeah. And the incentive structure within different industries is really different. Like agricultural supply chains versus construction, the incentive structure of who you work with and who's upstream and downstream is really different. So yeah, that makes a lot of sense. Want to sort of take a step back a bit and just ask you a question about your journey and experience as a founder with Orkestra. You mentioned you live vicariously through your wife who was working on a startup. Obviously, you weren't discouraged by that.
I probably should have been, to be honest.
What have you learned early in your journey as a founder that you underestimated or overestimated?
Look, I've been through some pretty challenging times personally with Orkestra. Like, if I could give any recommendation to any founder out there, well-being is greater than work. It doesn't matter how much stress you have from your customers, from your investors, the stress that you put on yourselves, because I imagine most people who are founding businesses are all ridiculously high achievers and all have high expectations of themselves. Certainly that was my experience, and I took on too much at one point in my business, and I nearly lost my business as a result. I was very fortunate to have a strong founding team around me that were able to carry the can for the 3 months that it took me to get better. And I just had a burnout. And that is, like, if I think about any new founders that are getting into this space, watch your mental health. You must prioritize that over everything else. Take whatever you do to manage your mental health. Don't let the business consume that time. Make sure that continues to be a priority, because it's a marathon, not a sprint. Like, it's a bit of a cheesy saying, but it's so true. And it's true because you need to make time for yourself as a founder and make sure that you have that time to decompress. So this morning, I went for a mountain bike ride and I got to work at 9:30. But it's because I worked late last night. And so every Thursday I make sure that they have that time. I go and have 45 minutes on my mountain bike on a weekday, right? And take that luxury to be able to do that. And it's a means of decompression so that you don't let the stress get to you. I'm become acutely aware of my mental state as an operator, and I can feel when I'm starting to push it too hard, and I know when to kind of pull back from the edge. And so I think as providing recommendations to other founders, meditate or do whatever you need to do to kind of become aware of your own personal state, and then manage that very, very closely so that you don't ever get yourself into that situation of being in the burnout, because, that is how you lose your business. And, you end up in a situations once you've got investors on board, you have a burnout event, they might kick you out of your own business. So you've just got to make sure that becomes number one.
I'd hope not, but yeah, that's very sage advice, James. Really appreciate the transparency and you sharing that. You've hinted on it. Would love to hear if you weren't working on Orkestra, which is obviously going to continue to be your life's work. What does outside Orkestra look like? You mentioned mountain biking. You're in Tassie. It sounds pretty ideal. What would you be doing if you weren't working at Orkestra full time?
Oh, chasing winters, I think. No, I mean, for me, it's like, spending time with my family. I've got 3 little kids, lovely wife who adore very much, spending time with them. I have interests outside of energy. I think this will be my last foray in energy. I've been in energy now for 15 years. I probably expect to be in Orkestra for probably at least another 5. But I think this might be my swan song in the energy space. Maybe I'll be back, but I'm going to need to change sectors. So, my dad is passionately into regenerative agriculture, and that sort of rubs off on me. My wife is passionately into property development and thinking about sustainable property development. So, I think I'll probably end up there at some point. But energy is a very, very exciting space. So don't let my reticenceness of the market rub off on anyone.
What you're saying is your plan is to leave such an indelible mark on the energy industry that you go into the Hall of Fame into perpetuity, and you're retired and you're put on the shelf. That's the aim. Last one, you write blogs. I don't know how active you like to be or whether you sort of block out social media, but if someone's been captivated by something you've said, wants to connect, where's their best place to find you guys?
Yeah. I mean, we're LinkedIn fans. Yes. I know lots of other people like Twitter and various other things, but I haven't got the time for it. No, LinkedIn is really where we share a lot of stuff. So follow either the business Orkestra on LinkedIn or myself on LinkedIn. you can hop onto our website. There's a bunch of our blogs. I don't write them nearly as frequently as I'd like. I'd like to try and get another one out in the next few weeks. But I tend to write stuff that is, I try to write stuff about the energy market in such a way that people with basic knowledge around the energy market can approach it. It can be quite technical at times, but I try and boil that technicality down to it so that it's kind of easy to digest. I also tend to be quite controversial.
I love them.
Say lots of things.
I've read a couple, and I'm not an expert, and they definitely meet that objective. So well done. I'll be reading more.
They've got to be fun to read. Like if you're going to read something as dry as energy regulation, you got to make it fun.
Absolutely, spot on. That's a great call. James, thanks so much for coming on. Really appreciate it. There's a lot of value in this episode, so really looking forward to sharing it.
Yeah, no, appreciate your time, Hunter. It was great chatting with you.